OpenAI will spend over $120 billion on compute in the next 2 years. They just raised approximately $122 billion. Do the math. No gap remains to run the business, pay staff, cover infrastructure, or justify a $150 billion plus valuation with strong returns. Yet every quarter brings new models, partnerships, and terrifying announcements. Safety gets press releases, DoD gets pitches. Investors get visions, real number filings get ignored. This is a capital markets tale in sci-fi drag, unraveling. Journalists hailed Sam Altman as tech's visionary builder. The New Yorker's 100-plus interviews revealed truth. Colleagues say he barely codes, doesn't grasp machine learning, and excels as a node, a connector exploiting others' greed. He is a node. That word matters. A node is not a builder. A node is a connector, someone who maps the people with power, reads what they want, and inserts himself as the indispensable link between them and the thing they're reaching for. Paul Graham made Altman the head of Y Combinator. Looking back, even Graham has acknowledged that Altman was not telling the truth the whole time. That was the foundation. Everything after followed the same logic: find the powerful party, locate their greed or their desperation, and use it. Microsoft, SoftBank, Oracle, CoreWeave. Each one of those relationships follows an identical pattern. Altman arrives, identifies what the counterpart needs to believe, and makes himself the vehicle for that belief. He is not building artificial general intelligence. He is building a network of people who need artificial general intelligence to be real. Those are not the same thing. And confusing the two is, at this point, no longer an accident. An anonymous OpenAI board member, speaking privately, said that the way the company was levered up was scary. A board member, not a short seller, not a critic on the internet. Someone sitting inside the structure, looking at the numbers and using the word scary. That is not a good sign. It is, in fact, a very specific kind of bad sign. The kind that comes from someone who has seen the internal reality and cannot quite bring themselves to say it plainly in public. But the person matters less than the machine he built. And the machine is what we need to look at next. The entire OpenAI business model rests on one idea: that the technology will eventually justify the spending. It hasn't. And the gap between those two things is getting wider every year, not narrower. OpenAI claims revenues of roughly $2 billion a month. That number gets repeated in press coverage as though it settles something. It doesn't. The more interesting question is where that money actually comes from, and whether the margin picture looks anything like what a sustainable business is supposed to look like. The answer, on both counts, is uncomfortable. OpenAI's margins have worsened every year. Not improved. Worsened. For a company that is supposed to be approaching the most transformative technology in human history, the unit economics are moving in exactly the wrong direction. OpenAI quietly shifted enterprise billing from flat monthly subscriptions to per-token charges. Every input, output, API call. No press release, no headlines, no financial press asking why a company with explosive demand hiked rent on loyal customers. Revenue growth needed a boost. They delivered it by making models burn more tokens and removing usage ceilings for heavy users. Not product progress. Pricing tricks. This forces the IPO question. If revenue and growth are real, show GAAP filings, not adjusted numbers hiding impossible costs. Pressure builds as full costs loom next. Training. OpenAI uses this word the way a magician uses a curtain. It implies something temporary, something preparatory. You train, and then you're done. And then the trained thing goes out into the world and earns money, and the training cost disappears from the ledger. That is the impression the word is designed to create. It is not what training actually is. OpenAI's training isn't one-time capex, it's endless ops costs, fixing model drift, patching failures, building next-gen models. Costs escalate yearly with no end. They frame it as a temporary investment anyway, masking reality. Wall Street Journal, over $120 billion on compute, mostly training, in 2 years. They raised $122 billion. Nearly all funding vanishes into this non-running cost. When does it stop? No answer. Anthropic guesses 2 to 3 years, no tech reason. It's accounting fraud at the core. Altman races to S1 IPO filing. Despite CFO Sarah Fryer warning numbers don't support 2026 public debut, he sidelined her. That says it all. The IPO pressure is not coming from a position of strength. It is coming from investors who got in early and need an exit. Altman himself does not hold stock in OpenAI directly, but he has every incentive to ensure that the people who do can cash out before the full picture becomes public record. Going public forces disclosure. The S-1 filing, the document a company submits before trading on public markets, will require OpenAI to present its financials under standard accounting rules, without the adjusted figures and excluded costs that have defined every number they have shared so far. The scale of what that filing needs to support is worth sitting with. All IPOs in the United States last year totaled roughly $47 billion in combined value. Goldman Sachs estimates the full 2026 IPO market at approximately $160 billion. OpenAI's implied valuation is expected to sit north of $150 billion on its own. The arithmetic on that is difficult under any circumstance. Under GAAP accounting, with training costs included as the operating expenses they actually are, it becomes something closer to impossible. Credit rating agencies will look at this company and see burn rates that do not improve, margins that move the wrong direction, and a core cost structure with no credible endpoint. Junk grade or close to it. That is not a foundation for the bond market appetite OpenAI will need to keep funding itself after the IPO. Once they go public, every hype announcement will move the stock in one direction. The actual economics will push it in another. I want them to file, show the guts. Because right now, the only thing standing between the story and the numbers is the fact that nobody has been legally required to reconcile them. That changes with the S1. And Altman knows it, which is why the shield he has relied on longest, the safety story, suddenly matters more than ever. AI safety is real. Models can spread misinformation. They hallucinate with confidence. They have been deployed in legal research, medical triage, financial analysis, environments where a confident wrong answer causes genuine harm. The concern is legitimate. None of that is in dispute. What is in dispute is whether OpenAI has ever treated safety as anything other than a communications asset. OpenAI's own published academic work states that hallucinations cannot be eliminated from large language models without a fundamentally new kind of mathematics. They wrote that, they published it, and then they continued deploying the same hallucination-prone systems into high-stakes environments while telling the press that safety was their North Star. The internal compute allocation for the safety team was reportedly between 1% and 2%. The figure that had been promised to safety researchers was 20%. That gap is not a resource constraint, it is a priority statement. Altman, the safety advocate losing sleep over his model since 2023, pursued DoD contracts amid Iran conflict escalation, pitching AI for targeting, intel, and military decisions. Behavior contradicts rhetoric. Anthropic joined DoD work in June 2024. Both prioritize safety only when required, faking concern to appease regulators, media, and justify risky deployments. Anthropic's 2026 Claude Mythos play, Too Dangerous for Public, released to 40 companies. Escape was a stage test, model got computer access, break orders, sent email, hyped as self-preservation and trailer-like system card. $125 per million tokens isn't safety. It's scarcity marketing for premium pricing. There is one detail that cuts through the entire narrative cleanly. When the Treasury Secretary convened a meeting to discuss the national security implications of Claude Mythos, JP Morgan was not invited. JP Morgan is one of the 40 companies with direct access to the model. If the concern was genuine, you would start there. You would ask the people actually using it what they are seeing. No one is panicking at JP Morgan. No one is panicking at any of the partner companies. The model is, by most accounts from people inside those organizations, interesting and expensive. 10 days after the Mythos announcement, Anthropic leaked the source code for Claude Code. The company with the dangerous, too powerful to release model could not secure its own repository. That is the safety company. That is who is holding the keys to the thing we are all supposed to be afraid of. And the question nobody wants to ask is not whether Mythos is dangerous. The question is whether the people who built it are capable of telling the difference between a marketing event and a genuine reckoning. Every time a journalist writes that CoreWeave has signed a deal with Anthropic, they are performing a service for Anthropic's communications team, free of charge, without realizing it. The pattern is consistent enough that it is worth naming plainly. A deal is announced, the details are absent. No revenue figures, no timeline, no explanation of how CoreWeave, which does not currently have the compute capacity, will fulfill an agreement with a company that does not currently have the cash to pay for it. The headline runs anyway. The implication that AI infrastructure is expanding, that demand is real, that the ecosystem is healthy, gets repeated across dozens of outlets before anyone asks the obvious follow-up questions. By the time those questions surface, the next announcement has already landed. The Financial Times published a piece examining whether AI was actually replacing or meaningfully augmenting white-collar workers in fields like accountancy. The finding was that it largely was not, but the article opened by entertaining the premise anyway, acknowledging the theoretical threat before dismantling it, because that framing is what makes the piece feel relevant. Every repetition of the theoretical, even a skeptical one, compounds the perception that the theoretical is worth taking seriously. And that perception is the raw material that OpenAI and Anthropic convert into fundraising. NVIDIA's Jensen Huang, top GPU supplier, recently warned investors, stop expecting fast returns on AI infrastructure. The world's largest chip maker says sold return timelines are unrealistic, a clear bubble signal. Financial press buried it as a footnote. Not journalist malice, but incentives. Stories affirming powerful institutions' narratives spread fastest. AI insiders know the problems: skyrocketing burn rates, shrinking margins, unfixable hallucinations, endless training costs. It's all in filings and papers. Yet nobody with clout calls it, because too many need the bubble alive. OpenAI is, structurally, we work with better branding and more dangerous downstream implications. A company built on the gap between what it claims to be worth and what the underlying economics can actually support, sustained by the conviction of investors who got in early and need the story to hold long enough for an exit. Anthropic is OpenAI in a different hat. The economics are identical. The CEO is more careful with his words. The outcome, absent a structural change that neither company has been able to identify, points in the same direction. The S1 will come. When it does, the numbers will be public, reconciled under standard accounting rules, with the training costs included where they belong. That filing will be the most clarifying document in the history of the technology industry, because it will make the thing that everyone suspected impossible to wave away.